Barclays just posted a massive beat across the board for Q2 2026.
Oh, yeah, an absolute monster of a beat today.
Total income for the quarter hit £8.3 billion. Earnings per share is up 43% year over year to 16.7 pence.
And you can't ignore that full-year guidance upgrade either.
Right, they're projecting approximately £31.5 billion in total income now. The stock is reacting exactly how you'd expect.
Yeah, surging on the open. Analyst chatter is completely wild this morning.
It really is. So for you listening right now, the mission for today's deep dive is to unpack this dense 70-page slide deck. We really need to figure out how a centuries-old legacy bank managed to post this kind of hypergrowth.
And more importantly, what their internal metrics are actually telling us about the real state of the UK economy.
Exactly. The UK economy, the US consumer, and the global financial markets. Because when an institution of this size reports earnings with this kind of momentum...
It's way more than a corporate scorecard.
Right.
You're basically looking at a live heat map of the global economy. I mean, they see the mortgage payments clearing, the corporate infrastructure investments getting funded, credit card swipes happening in real time.
It's an unfiltered vantage point.
Exactly. It's incredible.
Okay, let's unpack this. Because a legacy bank like Barclays, with hundreds of billions in assets, it's usually like steering a massive ocean freighter.
Takes 5 miles of open water just to turn the wheel a few degrees.
Yes. But looking at these headline numbers, specifically that 43% jump in earnings per share in a single year, it feels like this massive freighter is suddenly cornering like a speedboat.
Yeah, which is not something you see every day.
Right. Mature financial stocks usually measure growth in, low single digits?
Yeah, normally.
So let's look at their return on tangible equity. That 16.1% figure,
EH number.
ROTE, is essentially the ultimate scorecard for a bank, right? It measures how much pure profit they generate from the hard, tangible cash shareholders have invested.
Right, stripping out all the accounting fluff like goodwill.
Exactly. And jumping from 12.3% a year ago to 16.1% today, that is a massive leap in profitability.
It is.
So how does an enormous institution actually squeeze out that kind of genuine growth? I mean, I see their cost-to-income ratio drop to 54%.
Yeah, the efficiency is up.
But is this just aggressive cost-cutting? Like, are they just firing their way to profitability?
Well, cost-cutting is a factor, sure. But you cannot shrink your way to a 16% jump in top-line income.
Right, the math doesn't work.
No, it doesn't. So the high 50s was their stated target for the cost-to-income ratio. Hitting 54% shows they are operating remarkably lean.
Very lean.
But the real mechanism driving this is top-line synchronization.
Okay, what does that mean in practice?
It means we're seeing simultaneous aggressive momentum across both their retail banking divisions and their institutional arms at the same time.
Ah.
The presentation actually highlights this crucial detail. Over 70% of the group's income is now coming from what they classify as more stable income streams.
Which tells me this isn't just a fluke quarter. Like, it's not driven by a few lucky proprietary trades in the investment bank that just happen to pay off.
Far from it. When a bank generates 70% of its revenue from steady net interest income on loans, consistent transaction fees, predictable wealth management revenues.
It means the core engine is just humming.
Humming at peak efficiency. They've managed to optimize the balance sheet so that the traditionally, boring parts of commercial banking are throwing off highly attractive double-digit returns.
Wow. Well, let's look at where that money is actually being minted, starting with their home turf.
The UK?
Right. The Barclays UK division hit a 20.4% return on tangible equity, generating £2.0 billion in net interest income alone.
That's a staggering figure for a single quarter.
And the UK corporate bank performed even better. They delivered a 21.3% ROTE.
Yeah.
Now, here's where it gets really interesting for you listening. If you consume any financial news lately...
Oh, it's all doom and gloom.
Totally.
Yeah.
The narrative around the UK economy has been heavily skewed toward inflation hangovers, geopolitical stress, sluggish growth.
Everyone expects a recession.
Right. Yet Barclays is explicitly highlighting what they call a constructive macro backdrop. They're noting that over 80% of UK businesses actually have confidence in their own prospects.
Right.
It feels like the bank's internal ledger is completely contradicting the public pessimism.
The internal data definitely challenges that gloomy public narrative. I mean, they are seeing the real numbers.
Right.
And the key underlying metric driving this optimism is that UK corporate debt to GDP is currently at a multi-decade low.
Wait, really? A multi-decade low?
Yeah.
Let's dig into that mechanism. Why is it so low right now? Did companies just stop borrowing entirely over the last few years?
Essentially, yes. During the severe macroeconomic shocks of the early 2020s, companies went into intense survival mode.
So they just locked down.
Exactly. They hoarded cash, they paid down expensive debt, and they put all their major expansions on hold.
Okay, that makes sense.
So now we are seeing the coiled spring effect of that caution.
Because the balance sheets are clean.
Right. Because they spent years actively cleaning up their books, these businesses finally have the financial flexibility to borrow and invest again.
Wow.
For instance, the deck points out that 68% of UK businesses expect to increase their investment in cybersecurity over the next year alone.
That's a massive capital expenditure.
Exactly. When companies borrow to upgrade infrastructure, integrate new tech, expand operations, corporate banking loan volumes just surge.
The debt capacity was rebuilt, and now it's finally being deployed.
Yep.
And on the consumer side of the UK market, the presentation highlights strong real wage growth.
Yeah, which is key.
Right, because when wages outpace inflation, household balance sheets start repairing themselves too. That feeds directly into the strong net mortgage growth they reported.
It really does.
They specifically call out the integration of Kensington mortgages to help drive this. What's the story there?
So that Kensington acquisition is a perfect example of strategic growth. Traditional high street banks often struggle to underwrite specialist mortgages.
Like non-standard income.
Exactly. Think of self-employed individuals, contractors, or people with multiple complex income streams. The standard bank algorithms just reject them.
Right, computer says no.
Yeah, computer says no. But by bringing Kensington's specialized underwriting tech in-house, Barclays can now safely reach those underserved customer segments.
Ah, so they capture a market the other big banks are just ignoring.
Right. It allows them to expand their loan book organically without compromising their strict credit quality.
Got it. So the UK engine is firing on both the corporate and consumer cylinders. But then we have the other giant pillar driving this quarter, the investment bank.
Big IB. Yeah.
They generated £4.0 billion in income, which is up 20% year over year, delivering a 16.0% ROTE. The presentation shows massive strength in equities, advisory, and equity capital markets.
Huge momentum there.
But wait, investment banking is notoriously capital intensive.
Very.
And it can be highly volatile.
Yeah.
How are they managing the risk side of that equation while posting 20% growth?
By keeping a very, very tight leash on their risk-weighted assets, they have hard-capped the investment bank's share at 56% of the group total.
Okay, so for you listening, risk-weighted assets, or RWAs, basically dictate how much actual capital a bank is legally required to keep locked up in the vault as a shock absorber.
Right, the regulatory buffer.
Yeah, so a safe government bond requires holding very little capital in reserve. But a highly complex, illiquid derivative trade requires holding a massive amount.
Exactly.
So by capping the investment bank at 56% of the group's RWAs, Barclays is basically enforcing a strict diet on how much risk their traders can take on.
And that discipline is the defining characteristic of this earnings report.
It's all about efficiency.
Yes, they are generating a 20% jump in income, not by leveraging up and taking wildly outsized bets on their own balance sheet, but by capturing market share in highly efficient, fee-based businesses.
Right, like advisory and ECM.
Exactly. When advisory and equity capital markets are booming, it means Barclays is facilitating trades, they're advising on massive corporate mergers, and helping companies raise capital through secondary stock offerings.
Earning the fees without holding the bag.
Right. When companies have clean balance sheets, as we just discussed, they don't just invest in software, they buy their competitors.
Ah, M&A activity picks up.
Yep. Barclays collects hefty fees for advising on those deals without ballooning the risk profile of their own assets.
Okay, we've established the UK is rebounding and the global investment bank is humming. But to get the complete global picture, we have to cross the Atlantic and look at the US consumer bank.
Always a crucial indicator.
This division is essentially a direct window into the wallets of everyday Americans, mostly through credit cards.
Right.
The headline here is a ROTE of 10.5%. Now, they do note that number is adjusted to exclude a £225 million gain from selling their American Airlines portfolio.
Which, by the way, is a great example of active portfolio management.
How so?
Well, they aren't just holding assets forever, right? They are recycling capital and locking in gains to deploy where they can get the highest return.
Makes sense.
If you factor in that sale, the return was an astronomical 30.2%.
Wow. Okay, but sticking to the 10.5% operational return, there is one metric that immediately jumps off the page at me.
The loss rate.
Yes. Their loan loss rate sits at 555 basis points. That's 5.55%.
Yeah.
I mean, that seems dangerously high for a bank bragging about stability, doesn't it?
Well, look, in isolation, a 5.55% loss rate sounds alarming.
Right.
But credit portfolios require intense context. Barclays emphasizes repeatedly that their U.S. cards book is what they call super prime.
Super prime. Okay.
The average FICO credit score of their customers is 756.
Wait, the average is 756.
The average, which represents incredibly established prime credit history.
That's a really high bar.
It is. They also point out that U.S. consumer revolving debt as a percentage of income is actually lower than historic norms.
Interesting.
And Barclays' 30-day delinquencies are tracking well below the top U.S. card issuers.
Okay, but this is where I really struggle with their math.
Okay, lay it on me.
Think of it like Barclays running an exclusive VIP nightclub for credit cards.
I like it.
You only get past the velvet rope if you have a 756 FICO score.
Yeah.
You're super prime.
Right.
But if they only lend to the absolute most reliable VIPs, why on earth are they writing off 5.55% of those loans?
It's a fair question.
Right. If the velvet rope is that strict, a loss rate that high feels like a glaring red flag for the broader U.S. economy.
Whoa.
Like, what happens if macroeconomic winds shift and unemployment picks up even a fraction? Doesn't the profitability of this entire division just evaporate instantly?
That is the exact stress test every financial analyst runs on these portfolios. It's the first thing you look at.
Yeah.
But we have to understand the fundamental mechanics of unsecured credit. You cannot compare it to secured lending.
Okay, break that down for me.
For context, Barclays UK has a 90-day arrears rate on their mortgages of just 0.1%.
0.1%, almost nothing.
Right. And that's because a mortgage is backed by a physical house. If the borrower defaults, the bank forecloses, sells the asset, and recoups the cash.
Secured lending.
Exactly. Credit cards are completely unsecure.
So no collateral.
None. Even in a portfolio of 756 FICO scores, you have unavoidable life events, medical emergencies, sudden job losses, divorces.
Things you can't predict with a credit score.
Right. A certain baseline of defaults is absolutely guaranteed, even among the most responsible borrowers.
Because there is no collateral to seize, the money is just gone.
Correct. So the reason banks aggressively pursue the credit card business despite these guaranteed losses comes down to the enormous yield.
Ah,
Barclays reports that the net interest margin in the U.S. consumer bank, so the spread between what it costs the bank to fund the loans and the interest rate they charge the consumer, is over 13%.
oh wow, over 13% I am.
Over 13%.
Okay, the math is coming together now. If your spread is north of 13%, absorbing a 5.5% expected credit loss is basically just the cost of admission.
Exactly.
You still walk away with a massive margin.
It's completely priced into the financial model. They underwrite the portfolio expecting that specific loss rate.
They know it's coming.
Right. And as long as they maintain strict discipline at that velvet rope, keeping the average FICO at 756, they easily absorb the 555 basis points of losses and still walk away with a highly profitable double-digit return on equity.
It's just baked into the cake.
Yep. The internal data shows no signs of systemic stress. The book is performing exactly as designed.
Okay, so what does this all mean when we zoom out?
Right, the big picture.
Because making all these loans to UK corporations, global hedge funds, and US consumers, it generates massive revenue, but it inherently brings risk.
Definitely.
How is Barclays ensuring this £8.3 billion quarter isn't just a house of cards waiting for the macroeconomic winds to shift? Let's look at their defensive playbook.
And it's a very aggressive defensive playbook.
It really is. Their overall group loan loss rate sits at 51 basis points, which is perfectly within their through-the-cycle target of 50 to 60 basis points.
Right on target.
But the deck outlines some much more aggressive defense mechanisms, starting with risk transfers. They have £64 billion in risk transferred off their books, heavily featuring something called the Colonnade program.
The Colonnade program, yes.
How does a bank actually offload $64 billion in risk without just selling the underlying loans?
This is where we get into the highly sophisticated mechanics of synthetic risk transfers.
Synthetic.
Yeah. Under the Colonnade program, the loans physically stay on Barclays' balance sheet.
Okay.
Barclays maintains the client relationship, they continue to collect the monthly loan payments, and they earn the servicing fees.
So nothing changes for the borrower.
Nothing at all. But Barclays enters into agreements with institutional investors, like specialized credit funds or pension funds who are starved for yield.
Okay.
Barclays pays these investors a premium, which acts almost like an insurance policy. In exchange, if a certain portion of those loans defaults, the institutional investors take the first layer of losses. not Barclays.
That is wild. They
Hmm.
keep the client, they keep the recurring fees, but they essentially pay someone else to absorb the disaster risk.
Yes.
And that frees up their capital to go make even more loans.
Exactly. It immunizes the bank against severe downside scenarios while keeping the primary revenue engines running at full speed. It is a highly efficient way to manage regulatory capital.
Wow. And then there is the interest rate defense.
Oh, the hedge.
Right. Everyone in the financial world is constantly obsessing over when central banks will cut rates. But the slide deck leans heavily into a strategy called the structural hedge.
A massive piece of this puzzle.
They are actively locking in interest rates on a massive notional balance at a reinvestment rate of around 3.5%. The moment I read that, it felt familiar.
How so?
I realized it's basically like me fixing my mortgage rate for the next 5 years because I'm terrified rates will drop, and I want to guarantee my current costs. Only Barclays is doing it to guarantee their returns.
That analogy is absolutely spot on. Yeah, think about it. Banks hold vast amounts of deposits that are largely insensitive to immediate interest rate changes.
Right, checking accounts.
Exactly. Think of the billions sitting in basic consumer checking accounts that pay near zero interest.
Right.
Instead of letting the return on that massive pool of cash float up and down with the daily whims of the central bank, Barclays takes those balances and enters into interest rate swaps. They are proactively locking in a fixed yield around 3.5% right now over several years.
So they are building a massive earning shock absorber.
Yep.
If central banks slash rates tomorrow, Barclays doesn't care because they've already locked in their yield through 2028.
Exactly. And this raises a critical question in banking strategy regarding long-term liquidity versus short-term rate volatility.
All right.
By locking in billions at these yields today, Barclays is mathematically ensuring a massive buffer of guaranteed income for the next half-decade.
Which gives them enormous visibility.
Exactly. It's a structural hedge that gives management the confidence to project a greater than 14% ROTE by 2028. They're taking the guesswork out of future rate environments and insulating themselves against any sudden dovish pivots by central banks.
Incredible. So bringing this all together for you listening, this Q2 2026 earnings report is much more than a victory lap for a legacy bank.
Way more.
The £8.3 billion in income is staggering, yes. But underneath the hood, the transactional data paints a really vivid macroeconomic picture.
It really does.
We have a rebounding UK corporate sector that has paid down debt and is actively investing in digital infrastructure.
Yep.
We have a highly resilient, super prime U.S. consumer generating massive yields for the bank without showing signs of systemic stress.
The velvet rope is holding up.
It is. And we have a booming global investment banking environment driven by highly efficient fee-based revenue.
And remember, it's all protected by a £64 billion risk transfer shield and a multi-year structural hedge.
Right.
It is a masterclass in balance sheet optimization.
It really is. Now, before we wrap up, there is one detail sitting in the subtext of this presentation that we need to leave you with. A thought experiment to mull over.
Right. It comes back to that structural hedge we were just talking about.
Yeah.
Barclays is aggressively dedicating massive resources right now to lock in a roughly 3.5% yield for the coming years.
Right.
So if one of the world's most sophisticated financial institutions with unparalleled visibility into global economic data is this eager to lock in today's yields to protect their 2028 income.
Oh, I see where you're going.
Right. What does their internal modeling truly say about the trajectory of global interest rates over the next half-decade?
I mean, if they're rushing to lock in 3.5% now, they must think rates are heading much lower.
Exactly.
A very provocative question to end on. If you want to keep unpacking the market's biggest reports and cut through the noise, make sure to follow the show for our daily earnings coverage. Thanks for diving deep with us.